Welcome to the Traders Clinic, your regular shot in the arm of trader insights, philosophy and knowledge, brought to you by two professional money managers, Ali Crooks and Charlie Burton.
In each episode, we answer your burning questions, and we also cover all things from the world of trading.
Well, another week, another dollar.
There you go.
So what are we looking at?
Another week, another dollar, I like that.
Yeah.
So, starting off with fear. So the title of this one is The Demon of Fear.
Yeah.
And you've got a really good example of what goes on for people out there who are essentially gripped by.
This was a fascinating one. I had a message come through saying, after studying 2 years without touching a single trade. That's quite incredible. And it's almost now 1 year that I've been trading on a very small size, he said. I'm not getting any profitable strategy with at least a 60% win rate, and I'm on the verge of quitting. Can you help? So, wow. Yeah.
Alarm bells.
Alarm.
Yeah.
You know, and we're not laughing at that individual at all, because it's very, very common.
Yes.
Traders are either prone to have fear or greed to some degree or another, but some people are right at the one end of the spectrum of greed, or the far end of the spectrum of fear. And this person is certainly right at that far end, and that's why we've said warning flags, because if you've studied for 2 years without placing a single trade, that's telling us certainly fear, but so he's looking for certainty, 100%.
Yes.
Because he's not placed a single trade for 2 years. Then he's traded on, as he said, very small amounts. And there's nothing wrong with that at all, once you do go live.
Yeah.
But again, it's all adding up. And then he's saying, and he's not making any money, he can't seem to find a strategy that works with a greater than 60% win rate. So, wow. I mean, how do we go about this person's issue is his fear of loss or whatever, and wanting to be right more often, because that, if you're right 80% of the time or 70% of the time, then it overcomes your fear of losing, but unfortunately, one thing he needs to change the focus of his attention from win rate to profitability, and start looking at, profitability of his strategy or approach, rather than I must find a strategy that has a win rate of greater than 60%, because he might find that he can find a strategy with a win rate of 45%, which is highly, highly profitable. And then he's just got to get used to the fact of mentally, right, I'm going to be wrong 55% on average of the time. And don't measure your success on one trade or two trades. Look at it over 500 trades. Desensitize what you're doing. Because if he's been trading for the past year, that's fair enough. But I think he's probably still so searching for a high win rate strategy. That's his problem.
Yeah, I think the alarm bell for me was when he said you've been paper trading for 2 years. It doesn't sound like he was just choosing to paper trade for that period of time to become as good as he possibly could before he traded with real money. That sounds like you said he was searching during that period of time. He was probably searching and changing and looking for this strategy that has a 60+ win-loss ratio. And I think the key thing there is sometimes it's very easy, especially if you've not got a benchmark or somebody to feed off of, that you think what you're doing, because you're fulfilling your beliefs. If you're fear-based, then you're going to be more certainty-based, like you said, more security-based. So the actions that you take are reaffirming that. And sometimes the person doesn't even know they're doing that. So they're at the far end of the scale from our perspective, but to them, they're on point, because they're looking to find a strategy that fulfills their beliefs about what trading should be, sometimes even subconsciously. So I think if these people can, because he's not the first person that's done something like that, he's getting some sort of feedback or getting the opportunity to discuss it with a trader who's got a bit more experience. A line like that, rather focus on profitability instead of being right. That one little line could completely shift their perspective. But we see it all the time, and you see the opposite. You see the person that jumps in straight away with 20 grand and thinks, well, what's the click. Yeah. And invariably, most people have got to look at where they're at and probably do more of what they're avoiding. So this guy's got to look at it and say, right, I've got to get in and, accept that I'm not necessarily going to get this thing I'm looking for, and I'm going to have to learn to trade and accept more losers, whereas somebody else has got to go, hang on a minute, you need to calm down, trade with lower amounts like this guy's doing, and be more centered. So it's coming into the middle of the scale essentially, and finding the right spot for you. But I see it a lot. I see people just assume that profitability equals being right. It's almost a reaction. You say, how many of you would assume? I've asked the question to traders, how many of you in 5 years' time think your win rate will be better than it is now? And most of the traders I ever speak to who are in their first 6 months will say, oh yeah, I'll be doing way better. And I'm like,
yeah,
actually the stats suggest the complete opposite. You'll probably actually have a lower win rate if you're successful, because you'll have desensitized yourself to the losses, and you'll be able to handle bigger risk to rewards.
Yeah, and I think he needs to embrace the uncertainty of the market, embrace it. So welcome the uncertainty. That needs to be something that you're willing to accept into who you are as a trader. Because if you fight it, if you're fighting, no, I don't want that uncertainty thing, well, there's always uncertainties in the markets that are outside of your control. A lot of the things that we do as traders, there are the controllables and there are the uncontrollables.
Yes.
So the things that we can control are things like back testing and our execution and our trade plan and all of that. Those things are within our control. But the outcome of any individual trade is completely outside of our control. So we've got to embrace all of those uncontrollables and accept that they are there. But over a large enough sample of trades, if we are doing the right things, then it doesn't matter if we're wrong a given percentage of the time. But he's got to accept being wrong, and that's where he's struggling at the moment. Yeah. His focus is on the wrong thing. Focus on the profitability, and he might actually find a strategy that works for him.
Yeah, good.
Still going to have to work on the mindset though, because
yes,
he's got to get used to, oh, okay, if I'm going to be right 45% of the time, I'm going to be wrong 55% or whatever the stats are.
I always say, think of it in terms of minimum. Think of it as in terms of 100 trades. My next 100 trades, I'm going to be wrong on 55 of them, and I don't know how those 55 are going to land. Yeah,
that's true.
And and I think what he's probably doing as well is trying to outwork that. It's like if I can study backtest, do all this stuff, I'm going to be able to outwork the inevitable. And he's he's looking away from it. It's like, well, if I just do all this over here, I'll solve that problem. And invariably, you won't. You've got to, like you said, accept the hit. Yep,
exactly. No, good one. Good luck to that, chaps. Yes. Anyway, and like all of the questions that we get into the show, we try to answer them in a fairly short, sharp fashion. But we always want the best for anyone who writes in. And
we appreciate the questions coming in as well. It's good. So this one, interesting. I want to backtest, but never seem to find the time or motivation. Any suggestions? Well, we often we've had discussions about backtesting before, and again, what we tend to see is, it's a bit like what we've just been saying. You see the scale of people who do zero backtesting and just go in with either discretion, or they take a strategy on face value and trade it. Or you've got the other side, a little bit like the gentleman we were speaking before, who's probably doing too much testing different things, maybe got false hope about the win-loss ratio they can have. And again, for me, it's about finding a happy medium. So to get the motivation to answer the question specifically, well, think about potentially the fact that if you had some data, so if you've got no data on the strategy, if you had some data when you're having a winning run, would that be able to mute your over expectation of that continuing? If you're on a losing run, would you be able to look back at the data and see that although what's happening right now is different to what's happened in the past, if you've just had a 4-trade losing run, scan through the data and see how often that's happened over the last 3 years to give yourself a bit of perspective. So I always say, if you've got the data there, you can lean on it. You're not expecting it to be exactly the same going forward. And that's the challenge, is a lot of people who don't have the motivate or overly backtest is because they've got the expectation that now then they trade, they're expecting the same thing. Yeah. But the guys who do none of it are like, well, what's the point? Because it's not going to be the same going forward. But if you get the right perspective of what you're using it for, you've got a great saying about backtesting, which
I just say it's not my saying, but there's an old phrase that says backtesting is great until tomorrow. Yeah. And I think there is definite an element of truth in that as well, that backtesting gives you a framework to work within. but don't, as you've just quite rightly said, don't expect what happens tomorrow and next week to be the same as the data that you have. It might be, but it might not be, because markets do change and and vary. And that's why a lot of the time we have a common question is, I'll have people say, I've back tested all this stuff and then I started trading it live and it just fell away and I just lost money, and that's because of curve fitting. So that's the demon of back testing, is being careful and cognizant of what you're doing, and are you overly curve fitting as well. So that's something to but it's a really, of course, it's a really good endeavor to at least give you a base and give you some confidence in the approach, method, strategy that you're using, but at the same time be very aware that it's that's history, and history does change as well going forward.
Exactly. So I think to give him suggestions on how to do it. Well, first of all, I always say to people, work out whether you're going to be better off doing it as a batch, or doing little and often. For me personally, I will do little and often because I've got lots going on, like you, I'm busy. But if I'm looking to test an idea or a process, I maybe do 5 or 6 tests, 7 or 8 tests in a day, and do that for a couple of weeks. So I get a little bit of momentum and I've got a little bit of data, because once you've got some data, if this gentleman's struggling to start, once you've got some data, that can help to motivate you. Or you might find that you can clear a batch of time, maybe at a weekend, and you go through and do it. So find out which works better for you, whether it's better to batch or whether it's better to do a little and often.
One other thing when it comes to backtesting, more and more people are automating their backtesting. And one warning when it comes to automation of backtesting is that just gives you a nice printout of the success rate, the profitability, But that's not helping you when you actually start trading live with the strategy, because it just gives you stats. Oh, this was the win rate, and then again, what you need to do is delve into the back test and actually go back on the charts. There's nothing wrong with using automation for testing, but you then need to manually go back through the charts so you can see what actually happened. Take it back into replay mode, so you can see how the market got to wherever it got to, or if it failed or whatever, so that you can then start to mentally get into that strategy. Because otherwise, some numbers on a sheet are not going to help you, because like you said earlier on, as soon as you're going to have 3 or 4 losers in a row, you'll be like, oh my God, and then you'll come away from your strategy and you'll start jumping around.
Yeah, that's such good advice, using the auto scroll and experiencing it, and pattern recognition. If you're new to that particular pattern or format that you're going to potentially trade, get used to seeing it on the chart rather than just going, great, here are the stats, and then you start trading it and your lack of experience means you're not executing properly. So I'm all for, yes, get some stats, but actually go and look at it in the chart as well. Brilliant. Okay, last one. Great question here. Are overnight costs a factor in your decision when you swing trade?
Yeah, this one came through, and it was again, I think this is, sometimes you got the people out there who are day trading, that they think that day trading is, that's the only way, really, especially when they first come into trading. Oh, well, I can't have these overnight costs. And we always say, well, it's a cost of doing business. If you had a shop, you're going to have heating bills, you're going to have, all these things that kind of come out of the profitability. So you're going to have your sales, but out of those sales, you've got to pay for your staff, your heating, electric, or whatever. So, and to an extent, trading is a very low cost way of making money as far as your overheads are concerned. But that is a cost of doing business. It's something you can't avoid. These are the charges that are out there. It's the interest rate differentials between, if you're trading Forex, between one economy and another. And if we were talking about this earlier on, the Japanese yen, and you take the US dollar, well, there's about a 5% interest rate differential between the two at the moment. So if you wanted to sell the dollar against the yen, well, that's working inversely against you. So those swaps are going to be quite high because it's a very big difference in the interest rates. So I'm not saying don't short them, but again, you're going to have to be wary of a trade like that, of how long you want to be in it. Because this guy was talking about being in for multi-weeks, if not months. But if you're on the long side, then great, because you're probably going to be receiving that extra swap fee. So great, you're going to be making bit of extra money if you're on the long side as well. So it's definitely something to look at. As a general rule, I tend to look at of the profit, up to sort of 20% or so, maybe maximum of 30% really, of a build up of swap fees of the total profit. So, and I'll say that's acceptable. But if it starts going too much beyond that, if the swap fees are 50% of my profit, then I'm not going to want to be in that trade and hold on to it to the same degree.
No, it's going to. No, I think that's really, really good advice. And also, it's very dependent on what you trade. So, could you only look at long positions on some of those cross pairs or pairs that there's a big differential on interest rates? Potentially, the counter argument there is, but the opportunity could be that the right opportunity in front of you right now is to short trade.
Yeah.
So just do it. You can do a little bit of a bit of rough maths and go, well, okay, this is the difference in interest rate. This is what it could cost me if I'm in. Am I prepared to take that trade? And remember, in that scenario, it's one trade in your next 1,000. But in that moment, that trade can be all consuming, and you think, do I take it? Do I not? And especially in the early days, people want to be in the trade and be in the market, and then suddenly it's, oh, flipping heck, I'm getting all these swap fees. Yeah, well, you've got to look into that. And I think the mindset is people almost, especially newer traders, almost feel annoyed that they're having to pay it. And I'm like, well, like you said, this is such a great business from a cost base. You can do anywhere in the world. You've got minimum costs. If you're in the UK, you could be trading, through a spread betting account, potentially be tax free. So this is just one of the very small costs that you have to endure. So I think be aware of it before you start getting too concerned.
Yeah, that's the overriding message. It doesn't put us off. Both of us are big swing traders, and it doesn't put us off at all. And I will still hold on to positions for 2-3 months quite comfortably. But it's something to acknowledge, depending on, we use that dollar yen as an example because of this, it is a wide interest rate differential, but a lot of the time they're not. No. And the swaps are actually, yes, even if you're paying them and not receiving, because it does work both ways with a lot of brokers, not all, but even if you are paying a swap, most of the time they're really small. So it might only accrue to maybe 10% of your total profit. So I don't think he should worry about it too much. Be aware of it though, because sometimes the interest rate differential between two economies like those two could be quite wide. And if he was planning on shorting dollar yen and being in it for 2 months, that could add up.
Yeah, exactly.
But if he's only going to be in it for a week or two, don't worry about it too much.
Good. That's that. We're done. Another good episode.
Yes, indeedy. His name's Ali Crooks.
His name's Charlie Burton.
Trade safely out there.